Let's just find out what James Garish has on his opening call list. He is from Shaw Partners and the author of Market Matters, joining us live. James, welcome. So we've got the competing factors of lower commodity prices, big plunge in oil against positivity in overseas markets. How do you look at the prospects for investors and traders today?
Yeah, good morning to you guys. I think it'll obviously be a positive open given what the futures market is implying this morning. Oil down 7%, Nadine, is not necessarily a bad thing for the broader market, the broader economy. Obviously, it's going to be a slight negative headwind for the oil sector domestically. The energy producers were down about 3% in the US market. So expect that area of the market to be a little bit soft. BHP will be down and the other larger commodity companies will be down, but that'll largely be offset by a strong bounce back we should see in technology. Nasdaq up 3% last night, and some more broader buying amongst the industrials and the financials.
James, just interested to see, did you load up on commodities, or have you, over the past month or so, particularly, I guess, as that conflict got underway? What's your strategy just as far as commodity stocks are concerned?
Yeah, Andrew, no, the short answer is no. I think we've been reasonably bullish on commodities, particularly in the energy space, coal, oil, etc., on the prospect of tightening supply. If you've got this, the backdrop of what we're seeing in Russia and Ukraine obviously has provided a large pop in the commodities, but that wasn't our rationale for being long the space. And I think, from our perspective, we've been lightning into this rip higher, if you like, particularly in the oil side, particularly in the coal side. I get that, this is how we're managing our portfolios. I get that the backdrop remains very supportive, and these companies are going to produce a lot of cash if you mark to market to spot prices, but markets overextend on either side of the ledger. And I think in this case, I think commodities have probably overextended on the upside. And from a shorter term tactical standpoint, on medium term bullish the space, but from a shorter term tactical standpoint, we've been sellers and will be buyers again into weakness. Commodities are very volatile, they're very cyclical, and you should trade them that way.
And we know that you're not afraid to be a contrarian as well, James. Let's talk about Magellan. Magellan today, are you contrarian on Magellan? Because it's been one-way traffic there. Yes, they've launched this on-market buyback. We knew that this was coming. It was announced in the interim results. It's a sinking ship. Do you catch a falling knife?
This on-market buyback is a new announcement this morning. And it is going to be a positive for Magellan share price today, and I think it's going to be a positive overall. If you stand back, and I know this has been a diabolical stock in the last 12 months or so, it was trading above $70 a share. It's down below $14 a share. If you think about it, they're grappling with a whole heap of well-documented issues. If you dumb it down and think about the funds that they manage, they're managing about $70 billion at the moment. There's a lot of those funds walking out the door, but if you compare it just on the FUM versus market cap to other sector players, the market's pricing another $25 billion already to walk out the door. So it's priced for oblivion. The buyback today is going to be a positive. It's trading on about 8 times FY23 earnings. It's dirt cheap. So yeah, Nadine, in short, the short answer to that would be yes, I am a contrarian. It goes against probably what the house view is here, but certainly I'm a contrarian on that stock.
Yeah, but what's going to stop the bleeding there, James, particularly as you're talking about those funds walking out the door?
Yeah, it's more around market positioning, Andrew. So what is the market pricing in to this stock? So it's similar to a lot of these stocks that get really oversold. An example would be AGL Energy that got simply kicked to the curb when their underlying asset value is worth more than the share price. So if I look at active managers across the board, they've gone from an average P of about 25 times to sub 10 times. So they've really been kicked to the curb. The consensus or the view in the market is completely bearish, completely one way. So in my view, I think that has gone too far on the other side of the ledger. So what turns the corner is better performance and a reduction in fund outflows. So they had a large fund outflow number between February when they updated the market just the other day. If that slows and performance starts to improve, fund management is a confidence game. So if they can improve that confidence side of it, then the stock will bottom, and then it can experience a big re-rate in both the earnings multiple that the market will pay for it.
Now, James, so on Magellan, the board had previously announced its intention to consider a buyback at that interim results. So thanks for that correction. Now, speaking of bears, the NASDAQ is in a bear market. We saw, the lift through the overnight period, but we're still in a very volatile environment. Still, many investors talking about the pressure that will be put on equities as the central bank in the U.S. commences its interest rate hiking cycle. So how do you position portfolios for potentially bear market territory?
Yeah, it's a really good question, Nadine, and I think I'd tie in the comments just made before around how the market's positioning around rates. So, the Fed Reserve is likely to increase rates by 25 basis points when they meet tomorrow morning our time. That number was likely to be 50 basis points only a couple of weeks ago. So the market's changed its view around that rate hike. But priced into the US market is 7 rate hikes this year. So that is an aggressive number. So economists are slightly less. Economists think that the Fed won't be as aggressive. So that implies to me that the market's already pricing in this an aggressive tightening in monetary policy. I guess it's why we saw tech to some degree bounce overnight. I wouldn't be surprised if the market bounces on a 25 basis point rate hike and more dovish commentary by the Fed simply saying that this is going to be very data dependent. The trajectory of interest rates over the next year will be very data dependent, and the market's 7 hikes seems pretty aggressive to me, Nadine. So I wouldn't be surprised if it was sell the rumour and buy on the fact of rate increases.
Would your expectation though with tech be that volatility is simply going to continue though? You might well get that bounce this week. Next week could be a different story.
Yeah, I look again, Andrew. It's around. I guess it's around positioning. I think the market. Everything I look at in the market around sentiment. Sentiment is extremely bearish towards technology at the moment, and it's been rightly so. Obviously, tech. We all know that tech doesn't like higher rates, and higher rates are coming, etc. But markets position well ahead of time. Markets don't position for the now. They position for 6 months out into the future. So if I try and look 6 months out into the future, I think the outlook for some of these technology companies is a lot better than it is now. There's been a readjustment in the market. There's no doubt about that. But if I'm positioning, I'm sort of going against the grain. I think that sentiment implies that there's a real, the direction of most pain, I think, in technology is up, and markets often move in the direction of most pain.